Good morning, everyone. Thank you for joining us for this month's edition of Coffee Talk. My name is Sean O'Brien, president of QuickRate, and as always, I'm pleased to be joined by Steve Huntington. Steve is the director of analytics here at QwickAnalytics. And Steve, if you want to go ahead and introduce yourself.
Sure. Good morning, everyone. Thanks for joining us. So I've been working with Sean for about a decade now, but my experience and background is in working with community banks, which I've been doing for my entire 25 years. So year career, everything from strategic planning and valuation to M&A advisory, capital planning and model maintenance and building. But I've kind of brought those tools to bear in the environment that QuickRate and QwickAnalytics is in, and looking forward to speaking with you this morning.
Thank you, Steve. Today we're also joined by David Ruffin. David, for many of you may or may not know, leads our IntelliCredit division. We asked David to join us today because, as we've gotten into the, further into the CECL transition, different at times questions have come up regarding needs potentially for loan level types of analyses or more in-depth analysis, or perhaps even the benefits of segregating portfolios. So we brought David in here to just touch on maybe some of that. And then again, his 40+ years experience dealing with credit certainly can share insights that Steve and I do not have. So David, if you want to go ahead and introduce yourself, please.
Yeah, thank you so much. It's an honor to be with you, Sean and Steve. I've listened to on some previous coffee talks and am delighted to join. We are the newest division. I'm maybe the oldest lead of the newer division, but the one way to look at what we do, so much of what Steve works with QwickAnalytics, his energy source is public data. IntelliCredit's energy source is really the non-public, more idiosyncratic loan data. And we think we complement each other extremely well. And we hope you would see through that. And I think particularly as we get into a little more credit challenges, as I think the number of people now are feeling in the next couple of years, I think the way we blend those two between public and non-public data will be very informative in credit as well as CECL. So delighted to join.
Fantastic. Thank you, David. Okay, just a reminder, and again, thank you all so much for continuing to join us on these coffee talks. We hope and we certainly believe they've been helpful. And the format, I think, has lent itself to great participation and hopefully addressing questions that you might be encountering. Just a reminder, and for those of you who were on here earlier with us, you saw us work through a little bit of the technical difficulties, but you are muted. So probably the two best ways to interact this morning are through the Q&A box, where you can type your questions in. We already have one already kind of teed up from one of you. And then secondly, you can use the chat feature, and we'll be monitoring those throughout the discussion today and take those throughout the presentation. We will just touch on a few topics. We have made some changes, so we'll touch on that. I know from some of the feedback, as more of you are experienced users now, the need for us to kind of cover the tool is certainly minimized, and we have those webinars, monthly as well. So we will just do a quick overview just on some of the changes we made. But again, just a reminder why we're here today. CECL has been an ongoing discussion. I think most of us now are kind of in the midst of doing parallel runs. So as questions come up, we thought this would be an effective way to essentially crowdsource some of those answers and questions, provide maybe best practices and other things that we're hearing from experts in the industry, and then share certainly anecdotally what we've seen and heard from both, regulators, auditors, the banks themselves, and other experts. So again, we got a lot more to cover in the second half of this year, but certainly appreciate you joining this morning. So Steve, we want to take this question before we get started.
Actually, we see the question that came in, and I would like to address it in a few minutes when we're going to be
Yeah.
talking about prepayments a little bit, and I think it's
Okay.
a good time to discuss it. So we haven't forgotten about you, and we will get to it in a few minutes. Just extremely briefly, what the slide Sean has up on the screen is just kind of a summary result slide from the actual CECLSolver tool. Again, we're heavily utilizing the weighted average remaining maturity, or the WARM method, with some elements of open pool and snapshot as well in there. But once we get some WARM values, we plug them into the tool, and it's in an interactive environment. So everything's always recalculating on the fly, meaning any change, any assumption or input that you change, as soon as you do it, everything instantaneously recalculates. So you get a very good idea of what matters and what doesn't matter in your specific situation. But because, as David already alluded to, our energy source is the publicly available data, not only for your bank, but also for your peers as well. The second that you open up a tool, everything is preloaded into it as far as your entire historical experience with loan balances, charge-offs, recoveries, past dues, as well as your peers. So again, I'm not going to spend too much time on this right now. So if you go to the next page, next slide, Sean, just reminding people, when you build, when you're using our tool interactively and you build a scenario, you can save those scenarios online in the cloud there. You can save as many scenarios as you want to. You can export as much or as little of it you want into a PDF environment or an Excel environment. There's lots of places where you can make notes, something we try as a best practice, and you'll hear this from auditors and examiners a lot, is as important as your assumptions is going to be your narrative as to why they are appropriate. So building notes in at the segment level as you work through the tool is critical in being able to defend it, not only externally, but also remind yourself next quarter why you did the things you did this quarter, right, when you were building your tool. We also recently added the Fed tool, the Fed scale tool, as an option in there. So Sean, if you go to the next slide, just a brief summary of what the scale tool does. Again, this is not our take on the scale tool. This is the Fed scale tool and their methodology. We've made it easier for you to choose appropriate peer data to use within the Fed scale tool, because we don't think they necessarily did the best job in making that flexible and available to users. So we decided to do that for them and improve upon that. But again, you can save scenarios using the Fed scale tool to have something to compare our results to, or if that's something you're curious about. And then finally, in that next slide there, this is just where a lot of that data comes from. For the Fed scale tool, if you remember, some of the larger community banks and national and regional banks have to fill out that newer page on the call report, the Schedule RIA, which is the disaggregated loan loss reserve information. And if you mine that data, you can actually get a pretty decent idea around the country of what bigger banks are reserving at the segment level. Now, the segmentation is extremely limited, right? We're talking about 6 buckets here, so not a whole lot of detail or granularity here, but you get some sort of a feel for around the country and around the industry in some different segments of the portfolio where reserves are headed, which can help you not only in building an appropriate scale tool, but also justifying the assumptions you might make in your CECL model and everywhere else. So this data is all available to all of our users free of charge as just being part of the QwickAnalytics platform.
Great, Steve. I'm gonna jump in here real quick. Just a couple, things. As Steve just alluded to, we introduced and updated the scale tool. I was attending a conference recently in Florida, and there was a regulatory panel, and Jeff Geer, who was the deputy chief accountant, I believe, for the OCC, reinforced the notion that small banks don't need complex models. That's his direct quote. And I think what we are seeing now, again, increasingly as we move towards implementation, is even a greater acceptance of portfolio solutions, WARM methodologies. It really, truly is becoming, it already was, but it's increasingly the appropriate solution for community banks. As they have pointed out, the regulators have pointed out as well, banks, you're constrained by the data that's available to you. The call report is that energy source for most of you to do CECL. The WARM methodology is really becoming, again, it already was, but it's increasingly becoming the methodology of choice. So I know throughout a lot of discussions with banks, there's questions about, is this, appropriate or not? I think increasingly it's always been appropriate, but now the evidence is becoming even more overwhelming. And I think we're seeing that even with the new Fed updated, their LE tool is a warm methodology. So, I think we feel particularly, increasingly great about, our tool and how it's, it's helping banks and meeting what regulators are looking for. So in the midst of all that, we've gotten a number of questions, Steve, that I thought maybe we just jump into.
We might get to the first one, actually. If you go to the next slide,
yeah.
we've just added just the other day, added a new tab into the tool for held to maturity securities. I think one, if not two of the questions refers to this. This is obviously we don't have, it's a relatively open template, right? Where you can, but you now can come into the tool and without having to do it in a separate area or something that you as an addendum to your CECL model. We show you some historical data on your securities portfolio and then give you a space where you can add in your different pools of held to maturity securities, the ones that do have some risk of loss, right? I think that's important. I think Sean and David can speak to that. CECL does require not only an adjustment for the loan portfolio, but also potentially for the securities portfolio. It is limited to held to maturity securities, not available for sale. And it is limited to held to maturity securities that have, again, some risk of loss, right? Ones that are fully government guaranteed are outside the scope or have a zero expectation of loss. So it's really those type of held to maturity securities that have a real risk. Sean, you want to speak a little bit or try to answer those questions?
Yeah,
in that
I think,
context?
yeah, absolutely. Thanks, Stephen. I think, again, part of the reason why we were probably a bit tardy to having this is simply the realization that most of you in your securities portfolio, Steve touched on, you're holding either CDs, you're holding government treasuries, agencies, things that have principal guaranteed by the full faith and credit of government, government-sponsored mortgage backs, munis that are general obligation bank qualified. In most, if not all of those portfolios, there is very little credit risk, right? There is clearly potentially interest rate risk, but there is not credit risk. And as a result, it's kind of a de minimis amount of risk that most banks are holding. Now, certainly in everything, there's always the 80-20, 90-10 rule. And so some of you do hold some credit securities or maybe some sub debt, and then you can make that adjustment around the credit if you want. But again, we had it, with over 300 banks utilizing our CECLSolver, this has become an increasingly asked about item. And so we did, make the effort to include this within the CECLSolver now. So, David, I don't know if there's anything you want to add around those.
No, just as a third party kind of aside, one of our clients, actually, I'm coming to you from California today, speaking at a CCBN conference, but they've asked us to do some QCing, and I know just from the reality of the rate stability issue, rate hike, the interest rate risk on that, because part of this is we do look at some of that kind of from a QC standpoint. And of course, if heavy bonds, you got to start thinking about credit risk if you've got something other than those securities other than Sean alluded to.
Great. Okay, so couple of other additional questions. Steve, I don't know if this is the time to talk about the adjustments to the WARMs of greater than 10 years. Do you want to take that one now?
As soon as we get to those, I have the prepayment slides, and I think.
Oh, gotcha. I'm sorry. You told me
but
that.
To finish off the question, do you see credit losses for others, such as investments, unfunded commitments for off-balance sheet items? So yeah, we have another tab in the tool for specifically to manage the unfunded commitments portion of it. That's not technically something new. There's already, on the call reports, you already have in your other liabilities section of the call report an allowance for any off-balance sheet credit exposures. It's something that we see the vast majority of community banks simply put zero for that on their call reports and always have. Whether or not that was totally appropriate to do so is another question, but I think there's going to be a little bit more focus or renewed focus on it under CECL. And so our tool walked you through exactly how to manage and how to come up with an estimate for an ACL estimate for the unfunded commitments as a separate from the existing loan portfolio. And that's something that's across the industry, not just with community banks, but also credit unions as well are having to deal with that for the first time under CECL, because that was not something that they were asked as much about in the past. Good question.
Yeah, and I think that's the important distinction. And the ALLL off balance sheet items was an optional exercise. Some banks did, most banks did not. CECL formalized the requirement that banks address those unfunded commitments through the reserve. And so as Steve touched on, those numbers are available to us through the call report, and we've provided you a framework to
now it will remain a separate line item on the call report. It won't be the same line item. They'll still be separated, but it'll be more visible on there.
Yeah. Can you advise how CECL affects equity investments, such as a small, I'm assuming that's a small business investment company. I'm looking for guidance for that type of investment. I'm going to have to get back to you. I don't necessarily know how it would affect an equity investment. Again, these are really around credit losses. And so typically an equity investment such as this, I think, is being held at the holding company, not at the bank level. So I'm going to get back to you, and Steve, unless you have anything you want to add there.
I don't offhand. It's a good question.
Yeah. So Elena, we'll get back to you offline after that one, and then share the results, as well. Next question: is there a way to set a default for the peer group in new scenarios?
So when you pull up a new scenario, there's always, right now we just have I think the UBPR peer group is, I believe, the default peer group. But if you click on the drop down box for peer groups, you can always very quickly click on any custom peer group that you've built. So so there's no way to make it default to a custom one you've built, but it only takes a second just to click on the drop down box and then choose that that custom or state-based peer group each time you create a new scenario.
Yeah, and certainly reach out to customer service. We can walk you through that if it's not clear after the call today. The next question is about what about available for sale securities? So
not outside the scope of CECL.
Yeah, exactly. I was going to say that's exactly what it is. It's outside the scope.
Yep.
Okay. CECLSolver, I understood this is free. How can we access? So it's part of the QwickAnalytics subscription. So it's not free per se. It's part of the overall QwickAnalytics subscription. So access is granted through a subscription to QwickAnalytics. So you can certainly, again, we'll follow up.
Yeah. If you've had access to QwickAnalytics already, then you do have access to CECL.
Yes.
It's not an add-on or a separate payment or anything else like that.
Next question is, does the model have a validation if the regulators were asked for one from us? So yes, what we do have, and it's under the resources tabs. Let me slide back up here. I think we have a screenshot of it. No, we don't.
No, we don't have a, yeah.
Oh, here it is. Yeah. So up here in the top, in your CECLSolver homepage, there's a resources tab. When you click on the resources tab, you will see our SOC 1. So we did a SOC 1 after discussions with auditors about this. A validation particularly is focused around when a tool or a model is making assumptions. We are not making assumptions in this. We are actually working and calculating off of actual data. So the focus for the auditors was that we should do a SOC 1 where we test the controls and the processes and how we manage those and actually check the math and how we are calculating what we are saying and proposing to calculate and whether we're doing that accurately. And so that's what we've done and provided. And that is, again, found under the resources tab. Okay, so let's see. Hey, TM, prepayment assumptions. Here we go, Steve. Oh, let me see. There's one thing in the chat. Okay, so sorry, Steve. I got to you on the questions. So we got that. So Steve, you want to jump in here on the prepayment assumptions?
Yeah, if you go to the next slide. So we get asked all the time, what are some helpful or kind of industry standard assumptions we can start with for prepayments? Because using the WARM method, obviously getting a correct weighted average remaining maturity is pretty critical. And the math behind calculating a WARM is very straightforward. It's loan level, but it's very straightforward, whether you're doing it, whether you're getting it from your core, your ALM, or whether you're asking us to do it. And we can certainly calculate the WARMs for you. But once you do a WARM calculation, you need to affect that or adjust it to take into account estimated prepayments. Now, that means doing an entirely different, separate historical study of prepayment speeds within your different segments of your portfolio, which requires a lot more data than just doing a WARM calculation and can be pretty challenging. So a lot of our users haven't done that or don't have the resources to do it, and they're not getting much help from their core either. And so they're kind of left to the wind as far as to the wolves as far as what kind of assumptions should we use for prepayments. Now, our WARM estimator just starts with a very kind of conservative standard 10% prepayment, but that is simply a starting point. And so we get asked frequently, is there any good industry data about what I should use for prepayments throughout the portfolio? So we spent a lot of time looking around, trying to find good industry data for that. Hadn't had a whole lot of luck, but more recently we found a couple documents that I think can help. The FHFA publishes what they call a prepayment monitoring report every quarter. It's surprising that thing isn't more obvious and available on their website. It's there, but you have to dig to find it. We finally found it. It gets updated every quarter, and it presents long-term average monthly or annualized monthly conditional prepayment rates, or CPR rates, for all Fannie and Freddie loans, average for all coupons and remaining terms. So that's a really good kind of single point. And you can see on the next slide, you'll see exactly how that, why don't you go to the next slide? So this is probably the best resource to give you a starting point. Obviously those are already, it's a CPR, it's a 1 month CPR, but that's an annualized rate. So this would be completely equivalent to the annual prepayment rate you'd want to plug into our WARM estimator or your own. It's been as low as 6-7%, and it's been as high as almost 40% annually. Obviously the last year or so, it's been dipping as the rate environment has started to finally go the other direction. So right now, prepayment rates around the 10 to 15% range. Long-term average, it looks like to me, just eyeballing this, somewhere in the 15 to 20% range. Anecdotally, from different ratings agencies that frequently put out press releases about mortgage-backed securities and whatnot, they're seeing numbers around 20%. So again, that should give you some sort of a starting point. Our tool starts at 10%, but again, that's sort of a plug just to get you started. Something more reasonable, in my opinion, looking at this data, would be something closer to 20% as an annual prepayment rate, long-term average for the industry for mortgage-related loans. So hopefully that's a little helpful. We'll post more data. We'll put some more stuff in the resources as we get more sources for this type of an assumption, because it's a big assumption, right? A prepayment rate of 5% versus 30% is going to have a massive impact on the estimated life of your loan portfolio, which CECL is all about, right? CECL is all about estimating losses over the remaining lives of the assets. So it's a huge assumption to make what that remaining life is expected to be moving forward.
Well, Steve, I'd like to add, if I may add one thing on that. In our world of M&A, and when we are doing due diligences, frankly, it's not portfolio mortgages that are anywhere near the driver. It's commercial properties and CREs and C&I performance. And unfortunately, and you've already alluded to it, the market is not really replete with a lot of comparative data in that. Frankly, a lot of the valuation experts like to consider that their proprietary information. And that's part of the value and frankly, the fees they charge around that type of activity during a due diligence or a credit mark environment, because that is obviously factored in as well in a credit mark. So I think the reality is I don't believe you're going to find a whole lot of public data out there around some of those commercial loan type prepayment speeds.
Yes, thanks. And thanks for that, David. And if you go to the next slide, we did find some data I actually went through the TALF, the Federal Reserve's Term Asset-Backed Securities Loan Facility, which is somewhat dated now, but at least they had been updating some of this stuff up until about a year and a half ago. You can get some of this data on that link there that we shared in the presentation. So the way they calculate prepayment speeds on asset-backed securities is differently for what they do for mortgage loans, because they need to make it as complicated as possible, apparently. But they use the CPR, or again, constant, that sometimes it's called conditional, sometimes it's called constant prepayment rate, which is an annualized calculation. But for some of the things like auto loans and whatnot, they use ABS, which is another horrible thing to call it. ABS stands for asset-backed security. It also stands for absolute prepayment speed. Why there's a B instead of a P? It's a good question, and it's very confusing. But in that data, we see some long-term averages for auto loans and some other types of non-mortgage related loans as well. And a 1.5% ABS, that's a monthly value, would have to be annualized. It would be annualized somewhere in the 15 to 20% range, or 18%, technically speaking. So we've also seen other ratings agencies talk about long-term average annual prepayment speeds for things like auto loans and other asset-backed in the 15 to 20% range. And so hopefully that gives you guys a little bit more data on the non-mortgage side as well. But certainly David's comments apply very much so here.
And, and I think, all of this is in the sense that we're going to continue to do this. As Steve said, the fundamental point, right, is obviously any higher level of prepayment assumptions is going to lower a WARM, right? And so this gets into the kind of the conversation around being accurate versus being precise, right? You can go to great lengths to try to be overly precise. The important piece is trying to be accurate. So a well thought out and a reasoned expectation around prepayment assumptions, is really ultimately what's most important. And again, we will try to fill in the blanks, if you will, regarding information from the industry that we think can help you assist it. But I think at the end of the day, the most important thing is just a reasonable assumption around prepayments for all these different sectors.
So that comes to our actual question.
Yeah.
Finally, has the model been adjusted to handle WARMs of greater than 10 years? So it's that the answer to that question depends upon what type of institution you are. The model handles WARMs up to, the tool handles WARMs up to 13 years, but that's assuming that you actually have historical call report data up to 13 years ago. So if the person asking the question is works for a savings institution or a savings bank that was an OT filed the TFR reports, right? The thrift financial reports up until 2011 or 2012, when everyone switched over to filing the call reports. They wouldn't have any data. There wouldn't be any call report data that existed before 2012. And so it would be, we couldn't use 12 years of data to calculate for the WARM if we only had 10 years of historical call report data. So that would apply to an old OTS thrift or a de novo institution, which simply doesn't have historical data beyond a certain point. If you're one of those institutions, then it will only handle a WARM up until we have the data. We are working on a workaround right now that would allow you to plug in, let's say, an 11-year WARM, even if you've only existed for 9 years. It involves some additional math. We're actively working on it right now. We will have it a little later this year for sure. But the reason I wanted to talk about prepayments at this point was because if you find your WARMs greater than 10 years, we typically see very, very low or lack of prepayment assumptions in there. If this is on your mortgage portfolio, which I'm guessing it's probably on your mortgage portfolio, and your WARM is coming at 12 years, my suspicion is you're using a 5 or 10% prepayment rate, where you should, in my opinion, probably be using more of a 15 to 20 to 25% prepayment rate, which would bring your WARM down to in the 6, 7, 8 year range. And just sort of anecdotally, the typical lifespan, I know this is changing with the rate environment now. Most mortgage loans don't live more than, 7, 8, 9, 10 years from birth to death, just because of refinancings and selling, home sales and everything else. So I would take a closer look at the prepayment rates if the WARMs are coming out that long. But if it is accurate and that's what you want to use, then we will have a solution for that exact situation. It's a good question.
Yes, thank you. The next question is a follow-up on these available for sale. So Jordan, I think here's the distinction I think that's maybe being, maybe potentially misinterpreted. I see the question regarding, when it's less than amortized cost, but like for instance, today, banks are holding government-sponsored things that have interest rate risk and have a fair value, not because of credit, because of interest rate. All of these things are with CECL are designed around credit. So if you had a debt security that was available for sale that wasn't government backed, then yes, then I think available for sale, all these things come into question. But we're talking, again, it's really unique to the security we're talking about. If you're talking about a pool of securities of government-sponsored entities, agencies, treasuries, mortgage-backed munis, again, there's interest rate risk, but that's not what CECL is talking about, right? Many banks all are experiencing unrealized losses in their securities portfolios. Those are not credit losses. Those are interest rate losses. So, and they're unrealized at this point. This is an assessment around the actual credit of the security. And I think that's maybe where we're getting a little bit off track. So happy to discuss this again offline in detail, but I think the important distinction is when for most banks, their portfolio is issues that do not have credit issues, not like I said, not interest rate type of issues. So, and so I see your next questions is if we must, if the impairment is due to a credit degradation. Yes, I think that is where we're going with this. So, so again, I think we can follow up on this offline. It might be better described. And then again, we can share it with the group, in the results kind of in next month's presentation as well. But good questions. Joel, your question around where the 10% prepayment factor is reflected in the model. It's actually in the Excel tool that we do to calculate the WARMs. So, Steve, I don't know if you want.
It's only a part of a tool. If you're utilizing our WARM estimator, if you're getting your WARMs from somewhere else, from your core, or you're calculating it internally, it won't be part of a tool at all, because when you plug in your WARMs into the tool, that's already prepayment adjusted. Where it would come into play in the tool is if you said, hey, we're using your WARM estimator tool, or we want you to calculate the WARMs for us. We use that Excel-based tool, which you can click on the right on the home page. And if you open that up, you'll see in there the all the WARM data by segment. And then there's also a prepayment assumption by segment right in the Excel tool. And that that defaults to a 10%. So there's a 10% plugged in there. But again, that's very basic, very conservative, just a starting point. So we wanted to get, again, some more accurate assistance to give our users.
Actually, I'm gonna pull up our estimator real quick.
Sure.
Show everybody. So if everybody bears with me 1 second here, I'm gonna pull it up and just show you where this is coming into play. All right.
And this question, by the way, is from our good friend Joel in New Jersey. So
yes. Okay, so hopefully everybody can see my screen. But again, in our Excel estimator that's located on the bottom left of the summary page, there's a link to our CECL estimator tool. This is what our team uses when we calculate WARMs on behalf of our banks. In each of the tabs down here, we go into the individual sections. You can see here, we default to a prepayment estimate. This is often typically 5 or 10%, as Steve touched on. So again, just in this example, if I were to raise this to 20%, it's going to take down the WARM from 4.8 to 3.7. So this is to Steve's earlier point that if you have a double-digit WARM, any type of increased prepayment assumption to say 15 or 20% is probably going to bring it under 10 years. And so again, this is our tool that we use to calculate the WARMs if we're doing it for you. It's certainly available to you if you want to use it to calculate your own WARMs. But this is where that prepayment assumption comes in. So it's not directly in the tool, but it's used in our calculation of the WARM that then goes into the CECL solver.
Yeah, and again, if you're finding your WARMs frequently above 10 years, then this is probably the first place you need to go and sharpen the point a little bit. There are always exceptions to the rule. The one that comes to mind is de novo institutions, right? If you have a portfolio or your entire portfolio is not a seasoned portfolio, it's all relatively new loans. You either just got into this type of lending or you're a de novo institution. Obviously, given that situation, your expected average remaining life is going to be longer. But for a typical segment that's been around for a long time, you've got loans that mature in 20 years, you've got loans that mature tomorrow. And so after taking it to prepayment speeds, you know, we very rarely see ones over 10% that are reasonable to us.
Yeah.
Sorry, over 10 years. Over
10 years.
Over
Yeah.
10-year WARM. Yeah.
Yeah. So the question came in, do you recommend recalculating the WARM quarterly, or is there a less frequent term acceptable to regulators? I don't think it's really a regulatory question. Again, I think this falls into a practicality question. I think for many banks, and so our initial assumption is to say, let's set the baseline or the table stakes. We should calculate this quarterly. What we find in practice or anecdotally for a number of banks is that your WARMs don't dramatically change quarter to quarter. So if that becomes the case, then yes, then probably something semi-annually is probably more acceptable. But we certainly suggest at least starting quarterly, monitor to see if there's dramatic changes. If there's not, then you're probably okay. It's not gonna, obviously, again, it's the accuracy versus precision type of thing. If the WARM's going from, 3.76 to 3.72, did it change? Sure. But did it, materially change? No. So
yeah, I would
really the test we're monitoring. Steve?
Yeah, I mean, I would say the thing that would change over time is really not right. Your unadjusted WARM, right? The time to contractual maturity is basic math, and there's no assumptions in there whatsoever. The one that's an assumption is the prepayment, and that can change as obviously we go through different interest rate environments. And so if the interest rate environment is relatively stable and you've done it quarterly for a couple quarters and it's not changing but a few basis points, you then have all the ammunition you need to tell your regulators, yeah, we haven't updated it for 6 months because we don't need to. But if the interest rate environment is changing, then you could go in there and instead of recalculating the whole unadjusted WARM, just plug in a different prepayment assumption, and then that'll affect the WARM a little bit differently, and then you can use that resulting one. That's why we separate out the prepayment assumption from the unadjusted WARM calculation, so that you have more flexibility if you're using our Excel-based WARM estimator for updating that without having to do any needless additional work.
Thank you, Steve. All right, so let's kind of continue on. Again, I think, David, maybe you want to touch on some of these. So, I think, certainly the environment's changing, right? This might impact our Q factors, going forward. I think I was presenting to the community bankers in Kansas yesterday, and I think there's certainly things that you can look out ahead of and see that, aren't necessarily captured in your Q factors today that could be a forward-looking adjustment. I think of one right now is just, again, back to the securities portfolio. For a lot of banks who are experiencing unrealized losses in their securities portfolio, a lot of times for liquidity or even potential, problems with loans, you might access, something in your securities portfolio. But now with losses in there, we probably won't do that. So I think there's, things that are going to continue to be, change our outlook on things. But David, if you want to jump in here and just maybe touch on some of these credit concerns that might ultimately impact some of the Q factors that banks are considering.
Yeah, I think you bankers out there in the audience are really dictating this, because a perfect example is I was speaking in January over in Phoenix to the giant M&A conference, and credit risk was not in any way, you could tell by the attendance of the group I spoke to, not of any real concern. what a difference, 4 or 5 months has made, because yesterday it was very obvious that's number one concern on people's minds. And I do think you have to accept that things are changing. I think what I say rather tritely here, that COVID sugar high has turned sour, is all the government largesse that got put out to forestall an economic disaster, while apparently helping in a lot of ways, it actually had an after effect. Obviously, we know that with inflation. Unfortunately, it's just my personal comment. I think the Fed is going to throw everything it can to focus on inflation, and credit quality will suffer, or at least it's fairly empirically determined that when you have this kind of rate strategy or rate increase strategy, and the inflation that we're in almost record territories month after month, it's going to weigh down on credit risk, and that's going to be an issue. I don't think anybody believes, and this is another one of those dynamics between portfolio or public data, I should say, versus idiosyncratic data. Public data has a very Sean and I are going to speak in a few weeks about second quarter data on what it means for the banking industry when the call report data gets aggregated. My hunch is we're not going to still see much movement in credit metrics on the public data. It's within that non-public data where things start to percolate first. And that's where I think IntelliCredit is totally focused, frankly. But I do think we're going to have to be looking out for the earliest signs of some of this stress. How serious it's going to be, we don't know, but certainly just a continuation of the benignness of credit over the last number of years, and the after effect of the government largesse. I do think post-booking within the industry is struggling. Salary inflation is contributing to that. Banks, we're hearing all the time, either losing or having difficulty retaining back shop talent to perform analysis and oversee credit risk. This is a time not to be light in your credit risk staffing. I think there's a lot of pressure on banks still to grow loans. Tepid loan growth over the last 2 or 3 years that's net of PPPs are not really sustainable for profitability and valuation models that the investment bankers keep pounding the commercial bankers about. But look where we are. Do you aggressively try to grow a loan portfolio with this growing credit uncertainty? And I do feel my biggest single fear, frankly, is that after such a benign period, we're going to have a potential for some overreaction by regulators and by investors over the first sign, irrespective of all this additional cushion we have in terms of reserves and capital following Dodd-Frank. So these are general concerns that I do have from a credit perspective.
Thanks, David. Hey, we're going to jump in and take a couple of questions that came up. When is the call report data generally available and loaded into the model? So 2 parts here. Steve, you can jump in as well. Your data is updated the day after. The pure data is obviously after all of the banks have updated it. In the tool itself, you can update the numbers for the balances at any time. Steve, you want to jump in?
Yeah, so your data, we're currently working on having your call report data update in the loan balances as soon as you file. That's not happening today, but it will be happening in the next week or 2 here. We're going to have that in the system so that if you file early, then your loan balances will be updated immediately. As of right now, it's not updated until the end of the month when we get all the rest of the peer data, but you can always go in and manually update your loan balances at any point in time. So that's something that's not just an end of the quarter thing. If you're doing a CECL update or you're updating your CECL calculation on a monthly basis, a big part of that process obviously would be updating your current loan balances for your GL, end of month GL non-public information.
And 2, just to make a distinction in within QwickAnalytics, right? Because obviously within QwickAnalytics, your numbers are updated the day after. As Steve touched on, we're working on to have that same feature applied to the CECLSolver tool. So again, just a slight distinction. QwickAnalytics, your quarterly data is updated the day after you file.
Yes.
With CECLSolver, we're working to have it to be that same way. And then obviously peer data for both is updated once everyone's filed. which then typically turns out to be the first or second business day after the filing period closes. So Celeste, thank you for offering that information as well in the chat feature. Okay, again, just a reminder, any questions you might have, I think David touched on this, again, IntelliCredit's our newest division. I think for any of you who've been on the phone with me during a CECL demonstration, I think one of the things that I believe, and I think David would concur, and he just started to allude to it about your own data. I think the future of Q factors is probably greatly enhanced by your own data, where you'll see things sooner than things might materialize or be documented in the call report. And so this is one of the many reasons why we began working on IntelliCredit, is because we think there's tremendous areas of value and enhancement, and CECL is one of them. By kind of capturing your loan level data, you'll have the ability to better monitor your own internal data, your idiosyncratic data, but that will give you potentially earlier warning signs about potential changes in credit that we think then can, obviously influence, your Q factors, or maybe just how you're thinking about your portfolio. So David, you're obviously much more qualified to speak to this than me, but just anything you want to add there?
Well, I think this is exactly where you make that transition selectively around looking maybe to loan level data. I think there's a bit of a bias towards public data being a little more historical. And I think there is a little bit of a bias toward loan level data being a little more informative from at least a short-term future perspective. The blend of the two, I think, is where you want to go. And I completely believe that the less complex banks don't need to overdo it. But I do think we're big advocates of maybe considering doing a companion stress test, for example, with your loan review. And we provide that. And that's a form, if you will, of loan level analysis. I also think there may be segments. One of the vexing legacies of COVID, unlike the last crisis of 12 years ago, which was largely focused on everything 1 to 4 family residential and all aspects of it, we've got a multitude of things to be looking for of where the hotspots may be popping up or percolating. And a lot of that, again, the telltale signs are all in the non-public or the idiosyncratic loan data. You might want to look at segments of the portfolio and then start trying to figure out how can we do a stress test on this particular point. But I will just cut to the chase. I think that the reality in the next few years perhaps will be that you're going to need to be much more proactive in writing your own script. And regulators will come in. This is a transitional period. I've been around long enough to have seen 3 primary approaches to the loan loss reserve. This is the third. And there will be, it was alluded to in the last coffee talk, there'll be some transitioning even among the regulators. But there's also a sense that if they see you as a deer in the headlights around understanding your risk profile, which is, by the way, very unique to all community banks, and it makes it very difficult sometimes to project to the rest of the industry. You've got to start saying, well, we had a customer in Nebraska, for example, that had the 650% of his risk-based capital tied into AgLend. The regulator came in with a biased proxy about you've got too much risk in one bucket. He was able to quickly disabuse them of that by showing how pristine and high performing his ag portfolio was. As you see, that type of thing I think is going to be needed to occur more and more and more in the next short while as we get, I think, through a little more bumpy waters in credit. We like to think that we do provide the classic loan review work as well. I do believe, honestly, whoever you use as a third-party provider, please start asking for bios of who the reviewers are, because as we move into more challenging credit, you are frankly going to need a team of reviewers that are skilled enough in the qualitative aspects of credit, not just the quantitative. of being able to persuade the bank that this might be a credit that needs more attention or whatever, or needs to be rated in a different fashion. But again, I know I heard something, I read it on CNBC, I think yesterday, about the market is now looking more for value than a product. And I heard it with the panel at this Innovate conference, which is FinTech here in California, that bankers are looking for people to, their vendors and their tech people, to add value on top of just a tool. And I would like to think, it sounds like a self-serving comment here for the three of us, we'd like to think this is exactly what we're trying to do for you, is provide value in addition to the tools and the functionality that we think we can offer.
Thanks, David. And again, I think part of the point, too, is, I think as we've talked to all of you, right, we firmly believe the portfolio solution will be always adequate and acceptable for a community bank. The challenge will be, as David alluded to, if you do experience any difficulty, then you may want to do, or maybe you'll be asked to do more at the loan level. That is why, again, we see CECL as an evolving concept, and we will continue to support and improve and offer additional services when they're needed. Our belief is if you don't need them yet, then there's no reason to employ them. But I think preparing for that with your own data is really the first step in that. And that will be certainly something we try to help, build a bridge for you and help you kind of construct so that you have that data available at the loan level to complement the portfolio level if you need to in the future. Hopefully you won't, but it's a pretty good insurance policy to have just in case you do.
And remember, Sean, that CECL expanded the Q factors. And I think that's exactly where a lot of bankers are going to be needing to utilize that, for continuing dependence on the Q numbers, because again, I think the public data is going to trail some of these idiosyncratic indicators as it always does. And so I do think we're going to be more focused on that, justification for that larger, what we used to call unallocated.
And if I can jump in at a general level here, is, I get questions all the time, I'm sure you do as well, Sean, that from banks that are getting to a certain size, and their concern is, once I reach this size, whether it be $1 billion or $2 billion in assets, am I going to be, quote, too big to utilize this approach for CECL, too big to use the warm method or to use your tool? Am I at some point in the future going to have to abandon this entire tool and start from scratch with another provider or another tool? And I think the answer to that question is no. If you get to a size where you have a certain amount of concentration that needs further analysis, or a certain segment of the portfolio that's been growing rapidly, where you feel you need a little bit, or your examiner or auditor feels you need a bit of a deeper dive, that's when you companion our tool with what David provides through IntelliCredit, so you can selectively zoom in to where you might be having some emerging credit issues, without having to abandon the structure and framework that you've built with your CECL solution through QwickAnalytics.
Well said, Steve. Yeah, well said. That's exactly it. And I think that's really the overwhelming point that we want to make to you is, we fully expect that the portfolio solution to take you well into the future. But if you hit a bump in the road, or you need to do something more, we're going to be able to support you. So,
yep. Question?
Yeah, a question came in: is using an attrition analysis in lieu of prepayment rates acceptable for the warm?
Yeah, I mean, I think it's 6 to 1, a half dozen of the other. Right, what we're trying to get to for the warm is just, what is your best estimate of the likely remaining life of this segment, of this part of your portfolio? So whatever assumptions you make to try to get to your best guess of the likely remaining life. So contractual life minus, anything that's non-contractual, right? Prepayments. So doing an attrition rate analysis is sort of builds in those prepayments as well. So I'd say, yeah, however you want to get there, as long as it seems reasonable and you have some narrative and some justification for it, that's fine.
Great. So just kind of wrapping up, I don't know if there's any additional questions. Please submit those now if you have them. Just a reminder, we'll be back on the line August 12th for our next edition of Coffee Talk. We do hope at that point our representative Josh from Warren Averett, an accounting firm in Alabama, hopefully his schedules will now allow him to be here. So we're shooting for that. Later than this month, on July 28th, Steve and I will do a more in-depth dive into the CECLSolver for any of those who are on, who this is your first introduction to the tool. We will do a deeper dive into CECL. I think, again, we're kind of at that halfway point for this year. We've got a lot of topics that we'll discuss here in the second half, particularly around closer to implementation about, measurement dates. But, again, I think we should all feel good about where we are. If you're starting to run parallels, I think that's great. I think most of you have continued to have, good credit, experience. So, I think we'll continue to see reserve levels kind of, at or where you have been. I think that's really what we've seen from the 2020 adopters and even the 2021 adopters. So, again, I think it's a good position we're in. We'll continue to address the questions you have. We'll continue to make updates to the tool with feedback from you, our audience. And so on behalf of Steve and David, I'd like to thank you again for joining us this morning. If anything else comes up in the interim, please let us know. Thank you, Barry, for the kind words. And we'll look forward to seeing and hearing from all of you again on the next coffee talk. So have a great weekend.